Hey everybody, welcome back to the channel. If you're like me and you've researched anything on YouTube or online about financial freedom or anything of the sort, you probably come or heard to know of the FIRE community. FIRE stands for Financially Independent Retire Early. It's about growing your nest egg now so that you can then retire early. Right? And that's kind of the concept here. And on YouTube, there's a lot of great channels out there that talk about this. I subscribe to them and follow them. And, you know, it's really, really inspiring. And another theme that I've been noticing more and more so here on YouTube is the theme or the concept of, you know, living a minimalistic life, going with less. I think this is something that Dave Ramsey talks a lot about. Living like nobody else today so that later on you can live like nobody else in the future, meaning you're not going to have to, you know, rely on your 9-to-5 job to pay for your living expenses, but rather, you know, you're going to have all of your debts paid off. You're going to have a steady stream of passive income that you can then rely to fund your living expenses. And on this channel, I really like to talk about this concept in every single one of my videos. Yes, it's my channel is titled Dividend Growth Investing, but really the way that I look at it, it's all about growing passive income or cash flow so that I'm not fully relying on my day job to fund my living expenses. And in the title today of the video, I want to talk about how I've recently changed my lifestyle in one aspect, in one thing that I do, and was able to save $800 a year. So $800, I mean, that might not sound a lot, but for me, I mean, that's a lot of money, right? And I've gone over to nerdwallet.com over here, and they have a compound interest calculator. I'll save a link here or share a link in the description below. I'm not affiliated with them. It's a cool calculator. If this is something that you're interested in, you know, you want to see, okay, how much could you, if you were to save on X and Y and Z, how much, and you were to invest that, what could you save from that? Or what could you gain from that? I'll share that here in the description below. But here, $800, you know, I'm talking, okay, if you were to break that down monthly, that's something that I'm saving monthly, that's $67, you know, and it's compounding monthly. If I were to save $67 a month and invest it at 3%, conservatively, 3% is not a lot, and over 10 years, I'm going to have over $9,500 in those 10 years. And the cool thing here is you can see the breakup between the interest and the principal. And you can see, you know, for the most part, it's just principal. It isn't until later that you get, you know, that compounding to come into effect. And that's really where you see the gains. If you were to jump ahead and look at it from a 30-year time span, that's where you're really going to see this exponential growth. And this is what gets me excited. On this channel, I'm not about, you know, getting rich quick. I'm not talking about buying low and selling high. I'm talking about a slow and steady approach to building wealth, to building passive income. And the cool thing about this is you can adjust it. Let's say, okay, you wanted to be a little bit more aggressive. You think that you can realistically get 4%, which is very possible. You know, you can see, okay, what would that look like, right? And then if you were to just invest this into a, you know, a low cost, low based, you know, index fund like the S&P 500 or the VTSAX, the Vanguard Total Market Fund, which historically has gotten around 7 to 8%. Let's see what that would look like, right? That's huge. If you're getting 8% on $67 over 30 years, you're over $100,000. And so this is really why I think this, you know, $800 a year on the surface might not sound like a lot, but if you're reinvesting this every single month, it can actually turn into a lot of money. And I came across this article from Yahoo Finance, and on this article, it was talking about Americans' biggest financial regrets and aspirations. And so when I see articles like this, I kind of do a self-assessment and I say, okay, well, you know, how am I doing compared to the norm, or what, you know, what this poll is surveying here. And, you know, for example, the top 5 financial regrets, I didn't save as much as I wanted. I think everyone's going to, you know, wish they had more or they've saved more. I think that's always going to be the case, whoever you ask. Even if you ask a millionaire or a billionaire, that there's no, understanding when you have enough. And a lot of people don't understand that enough is enough. And there's a great book by Jack Bogle, founder of Vanguard, who wrote about the concept of enough, which is, finding peace with what you have. And what I like to do is when I see these things, I look into my own life and I do a kind of a self-assessment and see, okay, how am I doing, right? And when looking at the top 10 expenses that people most want to cut back on, dining out, I think this is a huge thing, especially in the United States, where you have fast food restaurants on every corner. It's convenient. I think this is, I also kind of have to agree that, I really could dial back on that. By taking my lunch with me every single day. I've recently invested into, I use the word invested into Tupperware. I invest into Tupperware so that I can bring my own lunch with me to work every single day. I'm not a huge into clothes or shoes, so that's not such a big deal for me. Cigarettes, I'm not a smoker. Alcohol, I don't really drink a lot. Cell phone bill, there I am definitely, an area where this is something that eats away at my my monthly expenses, that eats away at my income. Going out to movies, I think a lot of us have this. I think we should have a budget for entertainment. We shouldn't just dial it back entirely. Groceries, coffee, gambling, streaming services, all that good stuff. But what I want to talk about today in today's video is I saved $800 on my phone bill. And this is something that is so simple. I don't want this to be really cliche or tacky. Oh, yeah, $800 on his phone bill. Great. Well, let me kind of share with you my experience and how and why I made the change. I'm a big fan. I'm a value-oriented individual. For example, if I were to go to Walmart or Target or wherever, and if I am going to purchase a box of cereal, and it's the same Special K cereal at Walmart or Target, I don't want to pay a premium just because I'm buying it at a different store. If it's the exact same service or the exact same good, I want to make sure that I'm getting the best price possible. And that's kind of how I view my phone bill. And what I've done is I've taken a look at, okay, well, what is important to me? What do I need? I need data. I need to be able to text, all that good stuff. But there's a lot of different services that I was unaware of, and I'm not going to make this video just about phone bills and switching and all that good stuff. I just want to share very briefly how I went about it, and if it's something that you're interested in, you can go check it out. But essentially what it is, and also I'll do a timestamp in the bottom. If you just want to jump ahead to the portfolio update, I'll leave a timestamp in the bottom in the description so that you can jump ahead. In today's video, I'm going to also talk about utility stocks and the utility pie that I have in my portfolio. So stick around if you want to, if you're interested in that. But essentially what it is before I was on T-Mobile, and in the United States, there's 4 big carriers. It's AT&T, T-Mobile, Verizon, and Sprint. And all of these carriers, they have their own cell towers, and they have their own expenditures, their own overhead, their own advertising budgets, and they have a lot different cost structures and liabilities than these other third-party companies. They're called MVNOs, or mobile virtual network operators. And you may have seen them, but what it is essentially is they're leveraging the cell towers of the big 4 here, and they're able to offer pretty much the exact same service that the big 4 are by leveraging their towers. It's essentially the same network. You're getting the same thing. And so I was confronted with the decision that, okay, I needed to change my provider because of the cost. I was paying $100 a month for my wife and I, and just $100 was insane. Just, when looking at what we could get somewhere else, and it just bugged me every single night, knowing, every month when I paid the bill, that I could be investing this money. And that's what I wanted to do. And so what I did is here where I'm at in Austin, there's some dead zones where you don't get coverage. And so I wanted to make sure that I stayed with my current provider. For example, for me, I wanted to stay with T-Mobile. I'm not affiliated with T-Mobile. It's just that's the carrier of choice for me and where I'm at here in Austin. And what I did is I said, okay, well, I wanted to see, well, what providers are there on the T-Mobile network. And so all of these carriers up here, or, these, companies that work off the T-Mobile or leverage the T-Mobile network, and I saw, okay, these are all the carriers that would be, or the providers that would be available to me. And then what I wanted to do is I wanted to make sure that, I could use it in Austin, right? Because that's where I'm living. And so what I did is I looked down here and I scrolled down, and I'll share a link to this website. It's whistleout.com. And I looked and saw, okay, the most popular cell phone carriers in Austin. And it's right here on the list, number 7. At the time, it was number 6 when I subscribed to it. And it's so much cheaper. It's $15 a month. And I actually decided to go through Mint Mobile. And I promise you, I did a ton of research before because I was bought in, right? I was using T-Mobile before, and just like, your typical brokerage account, like your TD Ameritrade, your Schwab, and Fidelity, I was used to those, and that's all I trusted. And so it was really difficult for me to give up that trust with those big name brands and try out a smaller player in the space, just like with Robinhood, just like with M1 Finance, right? I kind of took a leap of faith, and I went with Mint Mobile. And I've been with them for a couple of months now, and I just absolutely love it. I get the exact same coverage, exact same service, but for a much more affordable price. And when I come back and I look at this article, like, it really isn't something that I'm not changing my lifestyle. It's like the example that I used with buying a box of cereal, whether at Walmart or at Target or at Whole Foods. I'm going to go, because it's essentially the exact same thing. And with these MVNOs, it is essentially the exact same thing. You might have different, you're going to have a different app, a different interface, but it's the exact same service for the most part. And you can check here and you can see the pros and the cons. And I can tell you right now, from my experience, I have not experienced any of the cons here from switching. Okay, so that's how I was able to save, and I think in the future I might actually do other videos like this where I share, okay, well, how was I able to save? I think another expenditure that my mouth drops when I see the bill every month is groceries. Like, how much I spend in groceries is just ridiculous. It's just insane. And so I might be doing kind of another similar video in a different category, but in today's video, it's really just about, okay, well, looking at this article, what can you do, right? And I was able to, do a self-assessment, see, okay, what can I change today? And this was a couple months ago, and I ended up changing my phone bill, and my phone plan, and that's how I did it. And I'm saving $67 a month, $67 for my wife and I. And over 10 years, it's going to be, if we stay true to this plan and with inflation and all that good stuff, it's going to stay on par with this for the most part. But in 10 years, we'll have just shy of $10,000 invested at 3%, right? And so that's the whole concept of this. And what I talk about on the channel is about being self-aware and growing, looking at other things that you can do to invest to grow your passive income, right? Okay, so I want to go back into the platform and back into M1 Finance, and I want to take a look at the portfolio, kind of see where we're at. Year to date, we're just over $300 in earned dividends, and if you've been following the market over the last couple of weeks with the impeachment inquiry from the U.S. here, and with politics and the trade war and everything that is going on, there's a lot of turbulence in the market. But I can tell you, as a dividend growth investor, it really doesn't faze me. It doesn't bother me because I know what I'm investing in. I know what my strategy is. And this is something that I haven't had in the past. In the past, these market swings were really detrimental to my emotions. And it really got me, just so... It was so mind-boggling for me to kind of comprehend how can it be up $500 one day and then down $700 the next day, and these massive swings, and it just really didn't help me sleep at night. And so since I've been following this strategy, I can tell you honestly that it's been a huge load off of my back when it comes to stress and worrying about, okay, am I making the right moves, the right decisions for me and my family? And it also, it really gets me excited, right? And I know that there's a lot of commotion going on right now with all the major brokerages, with Schwab and Fidelity and E-Trade, all these others, eliminating their trading fees. I'm sticking with M1 Finance. If you are a follower or subscriber of Joseph Carlson, his video today, he's a great YouTuber on dividend growth investing. If you don't know about him, I would assume that if you're watching my channel, you probably have heard of Joseph Carlson. He shared a really great video on his opinion of Schwab and the others eliminating their fees, and I intend to stick with M1 Finance. I'm going to stick with them. I really like the idea of investing in fractional shares. It's possible that in the future that these other brokerages, that they also offer fractional shares. And if that's the case, I'm probably going to still stick with M1 Finance. I really like how I can set up my own pie, my slices, create my own index fund, for the most part, because I'm not paying an expense fee for when I'm holding these individual companies, and when I'm investing in them and I'm holding 10, 15, 20 in a slice, I'm not paying any fees for that. And that's what I really like about M1 Finance. So I'm not going to make an entire video on that. I think there's a lot of content out there around, is this the end of Robinhood? Is this the end of investing as we know it? I'm just, those are my thoughts on, Schwab and the others eliminating their fees. And I am 100% sticking with M1 Finance. I love M1 Finance. Okay, and so in today's portfolio update, what I want to talk about is I want to talk about the utility sector. I don't talk about this sector very often. It's not the most exciting or attractive industry to talk about. It's pretty straightforward, right? Majority of these utility companies, they have a monopoly in what they're doing. It's very difficult if you're in a certain area where only Southern Company is offered, or Duke, or et cetera, or whatever, you're pretty much stuck with them. And so with my portfolio, I'm a dividend growth investor. I don't invest into bonds. I'm looking for companies that are growing their business, and they're also growing their market capitalization. They're growing the profitability of their company, and they're also increasing their dividend. And they're repaying their stockholders or their shareholders in the form of an increasing dividend. So that's why I invest and what I talk about on the channel. But in the utility sector, it's typically a slower growing sector. They tend to, these companies tend to have a higher payout ratio. And the payout ratio is essentially what the company is paying out from their revenue, their earnings, and they're paying it out in the form of dividends to their shareholders. The higher the payout ratio, the less money that the company has to expand and innovate and to invest into themselves and the growth of their company. So you want to be aware of that. But the utility sector, this is one sector that you can have a company with an 80% payout ratio and it's still a profitable growing company. A lot of these companies are also regulated by the government, so there's other factors that come into it. Now, for example, if a technology company or like Microsoft or Visa, for example, were to pay 80% payout ratio, that would be something completely different. Okay, so I want to talk about I want to share here on seekingalpha.com, great website if you're interested in researching dividends for specific companies. Here with Duke Energy, for example, they have a fairly high starting yield, and that's also that's pretty much the case with utility companies. They have a higher starting yield, also because of the expense ratio, right? And so with Duke Energy, it is a traditional utility company, 80% payout ratio, almost a 4% yield. They've grown their dividend for 13 years in a row. This is what I really like looking at is, well, how fast are they growing it? Now, for me to invest into this company, this is really for an income-paying asset so that I can then invest into other areas or other slices of my pie, right? So I know that, for example, Joseph Carlson, he uses bonds for this methodology, where he's using a high yield in bonds to pay for other areas of his portfolio. I do this in my utility slice. I want a high starting yield in some of these companies so that I can leverage those dividends to then invest into other companies. Right, and you can see, so for example, these are more the higher starting yield with Dominion, ED, Duke, Southern Company. And I want these to grow. I want to grow these out so that they can act as active income, I guess you could say, to invest into my other slices. Another company that I want to look at is Southern Company, 4% starting yield, 88, almost 90% payout ratio. So this is really high. They've been increasing their dividend for the last 18 years. The dividend growth rate is fairly stable. It's beating inflation. So if you were to go with this, you're beating inflation, and it's a fairly conservative play. The next one that I want to look at is Next Era Energy, a lower starting yield, just over 2%, a 60% payout ratio. And they've been growing their dividend for the last 24 years. Now, this is something really interesting. Here, take a look at this. The dividend growth rate is just insane. It's 10%. This last year, 12%. Over the last 10 years, 9.5%. So this is a dividend growth utility company. Another one would be your WTR, 2% starting yield, 62% payout ratio. They've been increasing it for 25 years. They're now a dividend aristocrat. They've been increasing their dividend for the last 25 years. Just over 7.5%. This is in line with the S&P 500 over the last 100 years. Okay. The last one that I want to take a look at is American States Water Company. This has a much lower starting yield, a 60% payout ratio, which is good. They've been increasing their dividend for 10 years in a row, and their dividend growth rate is just over 7.5%. So also a dividend growth utility. Now, something that I want to take a look at here is if you were to look at the Vanguard Utility ETF, this is the Vanguard Utility Industry ETF, and some people just purchase this ETF to get full exposure to the utility sector. And if you want to scroll down here, it's on ETF.com, you can scroll down and you can take a look at the top 10 weighted holdings from ETF.com. And you can see in the top 4 weighted holdings in this ETF from Vanguard, I hold in my own portfolio. And with this, though it is a very low expense ratio, and we can take a look at the expense ratio, it is a 0.10% basis point, so 10.10%, and so not the highest, but in my portfolio, I'm getting exposure to all of these companies for free. And I get to choose the target allocation, the weighting, and I have a little bit more control over it. Now, if you're a new investor and you're just watching this video for the first time, or you've watched a few of my other videos, I think you would not be wrong by no means. Just if you were to set up your slices, say you had your passive income slice here and you had all of the industries here, you could have, for utilities, just the Vanguard VPU industry utility ETF. Like you couldn't go wrong there. And I think a lot of people do that. For me, what I've done is I've looked into these ETFs and I said, okay, well, which companies that they currently invested in, and then that's where I started my research, and then I've investigated and done my due diligence on each one of these individual companies. And what you can do with M1 Finance, right here on the invest field, it doesn't show the actual dividend rate and all that good stuff. What you can do is you can go into the research tab under My Pies, and then you can pull up and you can see, okay, what is the dividend yield of the entire pie, the expense ratio of the entire pie, the entire holdings, and you can go into the utility slice and you can see what are let's go back here. Let's go back here. Right here. This is what I was looking for. The dividend yield of this slice is 2.66%, 0% expense ratio. And what I could do, and I'll show you, it's really, really simple how you can change this up. If you want to change the dividend yield. Let's say, yeah, 2.66% is not high enough for me. Let's say you want a 3% starting yield. What you could do is you could adjust the allocation here. You could say, okay, well, I know that Dominion, Duke, and Southern Company have a higher starting yield, so you could bump these up to a higher percentage, and then you could say, okay, I want to get my 4% desired starting yield, and that's a way that you could do that. Okay, but for me, I've chosen a little bit of a different approach. I'm not investing for a high yield today. I'm investing into companies that are over time going to grow their dividend, and this is what we talk about in yield on cost. And I can share a link in the top right about a video that I shared on the topic of yield on cost. It's actually talking about the video that I shared about PPC Ian, and where he talks about that, and I actually go in and I look at the Excel sheet that he has, his yield on cost sheet, and you can take a look at that if you're interested in that and you want to actually calculate your own yield on cost. But everybody, this is kind of my mindset and how I approach dividend growth investing. And even in a industry like utilities, where historically and traditionally it's not viewed as a dividend growth industry, you can in fact invest in a way as a dividend growth investor in the utility sector. So that's how I've decided to do it. I'd be curious to hear how others do it. You know, I'm not saying that this is the one and true way to invest if you want to invest for dividends or such, but that's how I've done it and how I've decided to do it. So if you're new to the channel and this is something that you're interested in, go ahead and hit the subscribe button. I try to come out with new videos, new content every single week. I try to talk about a different topic every week while sharing my portfolio with all of you here on YouTube. I'm very open, I'm very transparent. I know that there's thousands of different strategies out there. This is a strategy that I've come to enjoy, and it's worked very, very well for me, and I intend to continue down that path. I'll leave a link in the description below on everything that we talked about on the NerdWallet calculator here. I'll leave a description to this article right here, not the actual article itself, but to this slide right here. I'll leave a link here to what is an MVNO if you want to check that out. If you're considering changing over or switching over from your current carrier. I will leave an affiliate link in the description if you are interested in Mint Mobile, and if you want to try it out, you can try it out. You get $15. I get $15. It's a win-win. But yeah, and also if you're interested, okay, well, are there any other carriers in my area? You can go ahead and you can check out, for example, Boulder. You can see, okay, what kind of phone plans are there in Boulder, Colorado, for example, and you can go check those out. But everybody, that's all I had for you today. Thank you so much, and I will catch you all in the next video.